Could Canada's oldest bank be facing one of its toughest challenges yet? With a mortgage renewal wave looming and a higher debt load, some investors are a wee bit worried. Fasten your seatbelts, folks. This is going to be a good one. The Bank of Montreal is a very old bank with history that spans more than 200 years. They have weathered everything the economy has thrown at them, and this includes recessions, world wars, a dot-com bubble, a housing market collapse, and even a depression. They have shown resilience time and again without a doubt. In addition to being rather huge in Canada, BMO does have a significant footprint in the United States. This footprint was recently strengthened by their acquisition of Bank of the West in 2023. This purchase alone added 1.8 million customers to BMO and has made them the eighth largest bank in North America by assets. That's not too shabby. Of course, when it comes to dollar and cents, this purchase did cost BMO the hefty sum of $16.3 billion and certainly has contributed to their higher debt levels. This comes at a time when a wave of pandemic mortgage renewals is starting to hit those Canadian banks. Many homeowners who locked in low interest rates are now staring down significantly higher monthly payments due to, well, we have higher rates now. This shift poses both risks and opportunities for BMO. On the positive side, their strength in mortgage lending could mean substantial revenue growth from higher rates. But on that negative side, it also exposes the bank to increased risks if borrowers struggle to keep up with those payments. How BMO manages this delicate balance will be critical for their short and long-term performance, no doubt. As I have mentioned many times, the banks have set aside funds for loan loss provisioning, which will help big time provided they've set enough money aside. BMO has put aside more than $1.1 billion, and that value is currently still growing. Of course, if their losses are lighter than expected, this could be a huge plus for them in the future. Despite these challenges, BMO has some strategic advantages that could position them well for the future. Their US expansion provides diversification and a buffer against powerful downturns in the Canadian economy. Additionally, the bank's focus on digital transformation is helping them stay competitive in an increasingly tech-driven financial landscape. A sub to the channel is the best way to bank on future content. The data used for this deep dive is from their Q4 2024 earnings report. As usual, I took a peek into that report and found a few highlights I did want to share with you. In regards to financial performance, they did manage to increase their return on equity this year up by 9.3% from the previous year. I do like a good return on equity value, so if you're knocking it up, I'm on board for that. They also reported a 9% increase in customer deposits, with an additional $61 billion compared to the previous year. Yeah, that's not too shabby. BMO was recognized as one of Canada's most admired corporate cultures by Waterstone Human Capital, highlighting its inclusive and empowering workplace environment. That does sound good, but to get to the bottom of how worried we should be with this bank, we need some fundamentals. Of course, if there are numbers involved, we need to call on the guru of graphs, the algebraic adventure, the one and only Mr. Math. We will start off with a little bit of their surface data. At the time of recording, their current value is coming in at $139.41, and they've got a market cap of $101.54 billion. Their beta, just a little more volatile than the market average, 1.16. Those earnings per share coming in at 9.51. When we look at their price to earnings ratio, that's coming in at 14.62. The average across their peers, 13.60. A few of those peers include TD with a PE ratio of 15.9, Scotiabank 13.0, National Bank 12.6, and CIBC coming in at 12.7. Their price to book ratio, that's coming in at 1.20, average amongst those same peers, 1.50. Their return on equity, we know what's up, it's 10.07, and that return on assets, 0.53%. Of course, return on assets with banks do tend to come in pretty low So a 0.53 is actually not that bad. These overall numbers do look good. They're pretty much what you would expect for a blue chipper. Let's peel back a layer and take a look at their cash situation. When we look at their revenue, that comes in at 29.03 billion, and they've got earnings of 6.93 billion. Those earnings are projected to grow by 8.08% per year, and they've got a profit margin of 23.9%. When we get to their cash flow, that free cash flow deeply in the negative, negative 40.98 billion. Operating cash flow not much better, negative 40.41 billion. Now, if you cringed with those negative numbers, you got to keep in mind the negative cash flow is not as concerning as you might think. They have been moving cash into loan loss provisioning as well as using some of it for their operational and investment activities. So I kind of was expecting it to be in the negative. Switching gears, let's take a look at their fair value. So their current value comes in at $139.41. Using a discounted cash flow model, we do get a fair value of $216.25. That does paint them as being undervalued by 35.5%. So what do the analysts think? Well, they have a 1-year target of $143.94. So that's a modest 3.3% growth over the next year. Of course, I do hate seeing a negative cash flow. However, that money is moving into their cash and cash equivalents. So I'm expecting that to be on the larger side when we get to it a little bit later. Okay, let's take a gander at their returns data. When it comes to dividends, they do have a yield of 4.562%. That is a quarterly dividend of $1.59 per share. Payout ratio on that, 69.51%. If we look at their 5-year average dividend increase, that comes in at 9.25%. Switching to returns on their 3-year return on investment, that's coming in at 0.70%. Total return on that after we add in the dividends, 13.24%. Their 3-year annualized, that's coming in at 4.23%. Switching to their 1-year, their return on investment comes in at 6.84%. Add in those dividends, we get a total return of 11.53%. Now, out of the big 6 banks, they have the second worst returns on the year. They're only beating TD, and well, that's really not a very high bar to beat. Nonetheless, let's dive deeper and take a look at their debt data. They do have a total debt of 296.02 billion, and their total equity coming in at 84.29 billion. So that's a pretty high debt to equity ratio, 351.3%. I will point out 5 years ago, this debt to equity ratio was sitting at 351.2%. So this level of debt does seem to be pretty normal for them. And remember I mentioned those cash and cash equivalents? Yeah, look at this, 395.74 billion. That's not too shabby. From this, you can easily see they have a very deep moat, and some of this money is set aside for loan loss provisioning. But overall, they do have the cash to easily survive a rough mortgage renewal storm for sure. Let's look at their short term. They have assets of 463.27 billion, and their liabilities coming in at 1.22 trillion. Oh boy, that's pretty big. Looking at their long term, their assets come in at 946.38 billion, and liabilities looking a lot better here, 101.41 billion. Earlier in the video, we did ask if they were carrying too much debt, but there's something you do have to keep into consideration. Carrying high debt is part of the bank's business model, so you really can't measure them with the same ruler we would use for most other companies. Yes, this is a lot of debt, but it's not an unreasonable amount, and that will factor in for sure. Now, if we take a look at their share dilution, you will find we got nada. They have not diluted their shares in the last year, so that's absolutely great. One other small thing I do want to add about their debt is that 68% of their liabilities are from low risk funding sources. So that does put those numbers into perspective a little bit better, I think. With that being said, I do think we have enough data to make that final verdict. Overall, the math is not that bad with BMO. And there is no doubt that they are a solid blue chip investment that will pay off on longer timescales. On the short term, they may still struggle, but I do believe they will continue to move up a wee bit. And continued rate cuts will help them with that for sure. BMO, despite the recent troubles, is still a solid foundation, circle the wagon blue chip stock. And for that reason, long term investors will still like this stock. Of course, on the other side, those passive income investors will more than likely be looking to the covered call bank ETFs to gain their exposure to BMO with an opportunity for, of course, bigger dividends. Of course, if they were going to hold an actual bank, this is one of the lower yield ones, so they probably wouldn't pick it based on that alone. Overall, I think this is a good investment for the mid to long term investor with a focus on stability and long term capital appreciation. Just be warned that the beginning of that trip may be on the rocky side. One last thing to take into consideration is the banks that are doing well right now, they may not have as much upside potential as a struggling bank. So that may be another reason to consider BMO in your equation. If you are interested in BMO, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Enbridge. Thank you for watching, and I will see you in the next video.